Okay, good afternoon, folks. We're just waiting for the streams to start meeting the demand out there. My name is Peter Armitage. I'm the co-founder and co-CIO of Anchor Capital. It's always an absolute privilege to be able to showcase some of the smart minds that work in our business and to take you through how we're viewing 2025. A little bit of news about what happened in 2024, but as I'm sure for those of you who follow financial news, things change so quickly out there that there's new news every day. Our friends in America create surprises for us. I think one of the things that surprised us this morning is how surprised people are when the surprises pop up. You know, Trump's talked a lot about tariffs, but the actual reality of him getting through and doing something is, coming through with it has certainly had an impact on markets. So today the futures are down about 1.5%. So I'm going to talk through our basic views of where we see the world. Then we've got some of the guys who run parts of our business from an investment perspective, filling in the pieces. It's a pleasure to have you all here. Over 1,600 people registered for this webinar, which is amazing. We think back to pre-COVID. We used to go around the country and see about 600 or 700 people. We now get an audience of multiples of that in a very short time period. So let me get started with my slides. Right, so we're going to tell you where we think the money will be made over the next 12 months, obviously with a focus on the shorter term, but ultimately in the investment world, one's got to look through it and be invested with a plan for a longer time period. This, just to remind you a little bit, for those who are not familiar with Anchor Capital or Anchor Group, that's now got about 250 billion rand of assets that we manage. We started from scratch 12 years ago. Very proud of where we've got to, and that we've managed to get families, corporates, and pension funds all around the world to buy into and trust what we're doing for them. We've started now, if you look in the right-hand corner, and putting the Credo brand there. The Anchor Group merged with Credo in the UK in October last year. And of that 250 billion rand, about 140 billion has been generated in good old South Africa, and about 110 billion in the Credo business, which operates a very similar business to what we operate in South Africa and the UK. It's a completely UK business, but I think with about half of its clients are in fact South Africans. Importantly, most of our clients, we'd encourage them to look at their wealth like global citizens. And if you look down at the bottom of that 250 billion, about 145 billion is invested directly offshore, and about 25 billion invested offshore from South Africa. So that would be via asset swaps or through the funds that invest internationally. In asset management companies, the focus is on good long-term performance, but I think it's really nice when you have a year like 2024, where I think across the board, on average, we would have beaten most fund managers or asset management companies out there. One can never say that with confidence, and we say it with great humility, because what you do find in this game is the stars of this year tend not to be the stars of the following year. So our intention is obviously to try and keep this up. But it's nice, and it's nice to pat the fund managers on the back when we have a great year. So across almost 2,000 CISs or unit trusts out there, we're 2 in the top 10, which is a remarkable achievement. We had the 7th best fund, the RCI BCI Worldwide Flexible Growth Fund, which generated 35% in 2024, and our Worldwide Flexible Fund generated a return of 33%. And you can see on the right-hand side, out of different categories of 40, 100, 200 funds, a lot of funds up there right near the top 10. In the bottom left-hand corner, we're equally proud of our partners Credo, who last year were named the best medium firm winner. And this logo is for 2023, where they won the best small firm. And then they got up into the medium firm category and won that as well in 2024. Then one of our funds won the Lipper Award, and the Cautious platform in 2024, the winner again. So So some quite exciting performances right across the spectrum. And then to summarize what we're going to tell you today, breaking it into the 4 different kind of key asset classes, from a domestic equity perspective, we're still fairly bullish on domestic equities. In fact, coming through the projected 15% return. We're staying our course on the South African equity overweight call. I think since the government of national unity was formed, equity markets have done very well, and we think that can continue. We think there's added optionality from a potential China stimulus that's certainly begun. We're a little bit cautious in the short term. The SA Inc. shares have done quite well, but now we need to see deliveries start to come through. We're in fact more positive on the return from domestic than global equities. The world looks great, or certainly the US does, from an economic growth perspective and a company earnings perspective. There's a lot of animal spirits around, and we've certainly been in a bull market for the next 2 years. And a lot of what Trump is doing is pro-growth. But we've been supportive of the bull market and been quite positive on markets for some time. But we have recently moved into neutral territory, and that's largely because valuations are near 20-year highs. So there's very high expectations built in, and if there are disappointments, the price of disappointments can be quite big. So we're certainly not telling people to sell their share portfolios. Our wealthiest clients are the ones who've invested with us in good quality equities and stuck with them for long time periods. But with new money, we certainly wouldn't just be buying an exchange traded fund. You've got to select shares very carefully, and that's the approach that we're taking. What Trump has certainly done from a global perspective is increased inflation expectations, and hence the prospect of rate cuts globally. The US 10-year government bond is effectively sets the price for money around the world, and that's gone up since Trump came in. Nolan's going to tell you a little bit more about that. But higher interest rates are bad for borrowers, but they're good for people who've got money. So domestically, we think you're going to earn more in 2025 in fixed income than we expected a few months ago. And our lowest risk core income fund is yielding about 8.75% with very low risk and volatility. From a global fixed income perspective, we think cash is looking interesting at 4% yields. So real returns locally and globally can be earned without taking any risk. We're expecting 2 rate cuts in the US in 2025. And Nolan will tell you if we think it's attractive term yield of 4 to 5 years is attractive to lock in the higher rates. Our Anchor Global High Yield Fund is showing a yield of 5.5%. So this is the table, which shows what I'm talking about in numbers. We recently sent out our Navigator, which is our quarterly document, which highlights what we think of markets and gives the logic behind our positioning. And you can see from a domestic point of view, we're positive on most asset classes, in fact, only negative on cash because we think you can earn more elsewhere. But a 15% from local equities, 11% from bonds, 11% from listed property. Nolan will tell you that we think the rand should be a little bit stronger by the end of the year. There's no doubt that Trump and what he's doing with all his bluster around the world has made the dollar a lot stronger, because if US interest rates are higher, people are more inclined to keep their money in the dollar. So we think if Trump hadn't got in, the rand would probably be trading at around 16 rand 50 to 17. So it's cost the currency, probably 1 rand 50 to 2 rand. So we expect a stronger rand over the course of the year. And from a global perspective, we're most positive on government bonds. We think the risk return there looks very interesting. With US 10-year government bond yields heading towards the 5% mark. 5% would be the highest in 20 years. So that's a pretty attractive return. We haven't gone negative on equities. I think most global investment banks are looking for that kind of 5 to 10% return out of equities over the course of the year. Nobody's really prepared to go out on a limb because the range of outcomes is particularly big given where we sit in global markets. And then in both local and global, the alternative asset class we think looks very attractive. Anchor has invested quite heavily, and about 2 years ago, we started a range of funds which gives investors the opportunity to invest in alternative assets without their money being tied up for years, which has usually been the restriction. And we'll take you through one or two of those opportunities. So that is the start. I'll now hand over to Seleho. And, usually we have the interest piece at the end of this, but we thought we'd mix it up a little bit. And Seleho, who's one of our global tech analysts, is going to delve a bit deeper into the AI market.
Fantastic. Thank you, Pete. I think a lot of attention has been placed on AI over the last 2 to 3 years. It's probably been the dominant theme, particularly in global markets over the last couple of years. And understandably, investors have looked at it from the perspective of who the winners are going to be. So investors have looked and asked themselves, how can we benefit from this, and which companies are really dominating in this field? The likes of Meta, Alphabet, and Nvidia have gotten a lot of screen time and a lot of attention from media and investors as this has gone on. But what we want to do is take a bit of a different tact, and we want to look at who potentially some of the first casualties of generative AI may be. And we're going to do that by looking at a couple of companies. We're going to look at how they've been impacted, and in some cases, what we've done about it in our portfolios. Okay, so the first company is a company that really needs no introduction. I think it was one of the success stories for not just American technology, but I would argue American business in general in the modern era, and that's Intel. Unfortunately for Intel, they have run into some issues recently. And nothing illustrates that better than this chart here, which shows data center revenue for both Intel and Nvidia over the last decade. You can see that back in 2015, Intel had really the dominant position or market share within data centers. And they held that market share or leading position over the subsequent few years. But over time, as time went on, and particularly in the last 5 years or so, you really saw this dramatic rise or emergence of Nvidia's data center revenue. And that's because NVIDIA is the leader of GPUs, and GPUs are better suited for AI use cases within data centers in comparison to CPUs, which is where Intel's strength lies. Now, obviously, they're not blind, they're not oblivious to this. So years ago, they could see what was happening, and they tried to pivot largely through M&A. The problem is it was a bit of a spray and pray strategy. So NVIDIA's head of GPU engineering, Jonah Albin, said this about Intel's strategy. He said, Intel's AI strategy is like throwing darts. They don't know what to do, but feel like they need to buy something, so they're buying everything. It's a bit harsh, but sometimes I think the truth does hurt. And certainly, if you look at the actual numbers in terms of total returns since ChatGPT was released, you can see that Intel has really significantly underperformed both the SOX index. The SOX index is a broad measure of the performance of the semiconductor industry, and then also the S&P 500. So Intel's underperformed the SOX index by about 100%, which is pretty dramatic underperformance versus one's peers. And even the broader S&P 500, they've underperformed that by about 80%. We're not saying that generative AI is the only reason that Intel has come under pressure. There are several others. For example, they completely missed mobile. Having said that, we do think this has been one of the reasons. The second company is Adobe. This is a company that we have had or held within our high street equity model portfolio at times in the past. We currently don't hold it, and we'll delve a bit into why that is the case. Now, Adobe is really the gold standard for creative professionals in terms of the software that they use. So if you think of photographers, graphic designers, videographers, those kinds of creative professionals, they are very likely to use Adobe software. Probably the most famous example of Adobe software is Photoshop. So anyone editing photos is likely to use Photoshop. And really, Adobe has had very little competition within this creative software space for a long time. But that changed recently with the emergence of these, what are called either text to video or text to image models. So if you look at what OpenAI came out with, in February of last year, they came out with a model called Sora, which is a text to video model. And what that does is it allows anyone to go in and via text, so you just type in a description, you say to the model what you want a video to contain or what kind of video you want the model to generate. You wait for it a little bit, maybe go grab a cup of coffee. And by the time you get back, you'll see a really high quality in most cases. The model isn't perfect, obviously, but in most cases, you'll see a very high quality rendition of the text description you gave in the form of a video. So this is a completely new workspace or new way of working for creative professionals. And investors have really taken note as a result. It's probably the first time in recent memory where Adobe's software has had some sort of meaningful competition. Now, the Adobe CEO had an interesting thing to say about this. He said, video, I think, will be even more of an accelerant for editing applications. I think this notion that the next Oppenheimer, which by the way, I thought was a very good movie, but the next Oppenheimer will be done using a text to video prompt is just not going to happen for decades. And so I actually think more so in video, there's going to be an accelerant as it relates to using text to video and then editing that using our applications. So essentially, the Adobe CEO is saying, look, we acknowledge that there's this new emerging form of software for creative professionals, but at least in the immediate future, it's more likely that people will generate videos in things like Sora and then take that video, put it into Adobe software and actually edit it. Unfortunately for him and Adobe as a whole, investors aren't buying that story at the moment. So if you look at how Adobe's performed in terms of its total returns since Sora was released, which was February of last year, it's underperformed the S&P 500 by 44%. And even the broader software space, it's underperformed that by nearly 40% in roughly a year. So investors are taking a pretty dim view as to how the likes of Sora and other text-to-video or text-to-image models are going to impact Adobe. As I said before, we owned Adobe historically. We sold out of it in April of 2024 in High Street, and this was one of the reasons why. The incoming competition from the likes of OpenAI and other AI competitors made the outlook a lot more uncertain than it has been for a very long time for Adobe, and so we decided to sell out of it. The last company we're going to look at is Chegg. So Chegg is an online educational services business. They focus on high school students and university students. So if you're a student and you have a question that you would like answered, for example, maybe you have a mathematics question. You might have the solution in the textbook, but perhaps you don't know how to get from the question to the solution. And so you can use a service like Chegg to actually take you through step by step and teach you how to do the question. Now, the issue for Chegg is that this is a perfect use case for something like ChatGPT or any of the competitors to ChatGPT, Gemini, etc. And those models in many cases are free for students to use, at least for the basic versions. And so that's really starting to impact Chegg's business. The CEO of Chegg said this on the most recent earnings call. He said, recent advancements in the AI search experience and the adoption of free and paid generative AI services by students have resulted in challenges for Chegg. I think he was understating things a bit. So they've started to see pretty sharp declines in revenue over the last 2 to 3 years after a dramatic rise leading up to 2020. And investors have really soured on the stock. The stock is down over 90% since ChatGPT was released. For context, over that same period, the S&P 500 was up over 50%, and Coursera, which is, I suppose, a peer of Chegg, That's down about 40%. So investors have really taken a dim view of the long-term prospects. And I think it makes sense if you look at where these AI or LLM models are going. And if you look at where Chegg's current offering is, I think there's a lot of overlap, and it's not clear where Chegg is going to take things from here, given their current business model. I'll end things off with what I think is a bit of a funny quote from Warren Buffett. He said, "I've always said the easier thing to do is figure out who loses. And what you really should have done in 1905 or so, when you saw what was going to happen with the that is the automobile, is you should have gone short horses." Now, obviously, we're in 2025 rather than 1905 today, but I think it's useful for us as investors to think about what the horse of 2025 is. One example was Adobe. We're not saying that Adobe is going to end up being a horse, but we do think there's a lot more challenges to its business than there have been historically. And so these are the kind of questions that we're thinking about in our offshore portfolios and local portfolios, actually. But that's it for me on generative AI. I'll now hand over to Nolan, who's going to discuss fixed income.
Thank you very much, Saleo. Appreciate. Hello, everybody. It is wonderful to be back, and thank you very much for dialing in to this quarter's Where the Money Will Be Made. I'm going to speak for the next 10, 15 minutes on fixed income. I'm going to start with the offshore world, then the domestic world, and then I'm going to talk about the South African rand. And those of you that haven't met me yet, as I said, my name is Nolan Wapner, and I'm the Co-Chief Investment Officer at Anchor Capital, along with Peter Armitage. So jumping in and talking about global yields, there is really one key event that's taken place, which is going to dominate all other events. And that is the return of President Donald Trump. So like him or hate him, it doesn't really matter. There are, however, certain realities that we are going to face over the next 4 years. And I think this weekend was probably a good example of one of those, which is policies are going to be a little bit more by surprise, by shock, if you want. So we've had some pretty hefty tariffs, possibly more hefty than we expected the US would put out on Mexico, on Canada, on China. And then at the same time, he put out policy by tweet, actually using his own service, but saying that he is looking at withholding grants to South Africa in light of our expropriation bill. So, lots and lots of changes, lots of surprises. Those are going to continue. And I think that is just part and parcel of investing for the next 4 years. So take it into account in your portfolio construction. Be aware, be comfortable that investments probably will be a bit more volatile. But at the end of the day, President Trump is looking at America first. He is looking at economic growth. We do know he measures himself on the performance on the stock market. So there are some positive opportunities. Just very quickly looking at the comments he made on our expropriation bill, do not agree with them. I think, the expropriation bill that was actually passed and signed doesn't really give the state of South Africa, the government of South Africa, any more powers than it really had previously. It maybe just takes a bill from 1975 and sort of modernizes it a bit. But certainly we don't feel that there's anything nefarious in there. Obviously, it's going to go through the final approval processes, etc. Looking at the actual grants, he's talking about withholding. The only meaningful grant we get from the USA is about 8 to 10 billion rand. It sort of fluctuates a little bit year in and year out. And that's for South Africa's AIDS program, HIV/AIDS. So he's basically looking at withholding that money. It accounts for just under 20% of our total HIV/AIDS program. And that's going to put us in a situation where National Treasury might have to stump up a bit of extra cash. Not meaningful in its own right, certainly not enough to justify the market reaction. But I think the message of, South Africa is potentially in the crosshairs, and the message of he is going to do some exciting things is what carries forward and what we need to take out of this. Looking at the other part of what Donald Trump talks about, he loves tariffs. He is very big on bringing tariffs in. He sees them as an economic weapon, and he likes to use them to sort of strong arm other countries. We saw that over the weekend where he talked about implementing tariffs on Mexico and Canada in particular, slightly lower tariffs on China. Now, very, very interesting. If we actually look at how tariffs work, let's take the Mexican example. He is put 25% tariffs on all goods that Mexico exports to the US. So if you're importing the goods, you're obviously going to pay your supplier in Mexico, and then 25% of the value of those goods you've got to pay as an additional tax. But where it gets interesting is that tariffs have a meaningful impact on currency markets. Peter mentioned earlier that the US dollar has strengthened significantly since President Donald Trump, became the sort of apparent. It became apparent he was going to win the election, and where we're at is that if you take the last 12 months, or if you take this chart, it shows you the currency moves over 2024. On average, the dollar strengthened 7% against all the other currencies. Mexico came under particular pressure with sort of 18% currency depreciation, Japan 10%. South Africa was a standout, only going backwards by about 2.8%. Our currency was actually relatively strong, but the sort of impact of tariffs and this very strong dollar sort of overwhelmed everything else. Looking at Mexico over the last 12 months, so instead of looking at just 2024, the Mexican peso has depreciated by 23%. So if you bought goods today from Mexico, you would pay 23% less if you're an American, just because your currency has strengthened, the dollar has strengthened. You put the tariffs in of 25%, what you're really doing is giving up that currency gain. So you end up in this situation where your prices, by virtue of these tariffs, are really going back to the levels they were at a year ago. You've benefited from the strong dollar. You've decided to tax imports, which gives up that benefit. Net, Mexican imports are actually going to be at the similar price to last year. Canadian imports will be slightly more expensive, though I suspect because it's well, it'll sort of we'll find substitution effects start to take place within reasonable amounts of time. So from that perspective, the point I'm making is that we don't see tariffs as overly inflationary, because the sort of current currency movements, if you want, tend to negate the effect of tariffs. We saw that last time tariffs were implemented. We've seen that again. And from that perspective, we think that yes, tariffs do have an inflationary impact, but it's quite often overstated. And we don't see a reason at this stage to panic as regards our view as to where interest rates are likely to go or where US inflation is likely to go. So in this volatile world, how do we actually sort of pull it all together? How do we look at the world and form an investment view? And the perspective we're taking at Anchor is we're actually just looking at what the data series is telling us. We're looking at the key trends that are taking place in the economy. And then obviously you've got these sort of surprise factors from economic policy, which are going to come through. But by and large, you can actually look through those. So if we look at this chart here, what you've got is US economic growth, the sort of annual economic growth on as measured every quarter. And you can see, US economic growth back in 2023 sort of peaked. And since then, it's been on a slight gradual glide slope lower. And that's good news. The Federal Reserve has actually been trying to engineer a slightly slower economic growth rate to slow down inflation in the USA. So I think our starting point is actually, the economy is behaving like it should. They hiked interest rates, economic growth slowed down a little, monetary policy is working, it feels good. And very interestingly, notwithstanding, President Trump's policies, the expectation is that the economy will continue to slow a little bit. Not slowing to recession, not slowing to problematic levels, but maybe just going from too hot to about the right temperature. Another chart we actually look at is, or another data series we can look at, is US unemployment. So what we've done here is we've taken US unemployment every 6 months. December 22, 3.5%, 6 months later, 3.6, 3.7, 4.1, and 4.1 again. Messages, and the point is there's a definite trend here that US unemployment has been increasing. It's been going upwards. Again, monetary policy is working. That was part of the design of what the Federal Reserve was trying to achieve, was to take, a labor market that was too tight and to just loosen it a bit, just to, to bring wage inflation to ideal target levels. What I would say here is that the Federal Reserve has succeeded, and that at unemployment levels of about 4 to 4.5% is consistent with the inflation continuing to slow to where the Fed wants to see it. Wage growth, or the salary increases in the US, again, a very clear trend. You can see how salary increases, guys were getting 5% increases, then it was sort of or 5.5%, then it became 5, 4.5%, and these days salary increases, wage increases are somewhere between 3.5% and 4%. Again, it's gone from too high to actually about where it needs to be for the Fed to deliver on its target. Consequently, you actually see core inflation, the Fed's preferred measure of inflation, coming down. So what's the message I'm trying to give with all of that? I'm trying to say that if you look through the political noise, you actually see an economy that is quite healthy, that has gone from too hot to about the right temperature. It is likely to continue at the right temperature for the foreseeable future. We see a lot of uncertainty as to how a lot of these policies will manifest within the economic markets, within the financial markets. But if you look at them and you really digest them, I don't think at this stage the impacts are necessarily that bad. And therefore, you've obviously got to be quite sort of in tune with the potential volatility. But we think that the US economy is doing about the right thing. We think as inflation keeps going down, there will be scope for further interest rate cuts. The US financial markets are pricing in one potential interest rate cut towards the end of this year. We think you could quite realistically see 2 interest rate cuts of 0.25% each. So that brings the global cost of money down, as Peter was talking about. And at this stage, that we think that cash yields of about 4% are quite interesting. And we think that you want to be investing in bonds which are 4 to 5 years from maturity. So you're looking to lock in interest rates for about 5-year periods. You're locking in sort of 4.5% to 5% yields. And that gives you potentially some interesting capital gains as well as these interest rate cuts come through the cycle. So from our perspective, that's exactly what you're doing in the Global High Yield Fund. We're locking in at the moment 5.5% US dollar interest rates, and the bonds are all maturing between 2026 and 2029, which means you've got a small capacity for capital gains, but you're also going to have a relatively stable investment. Then turning towards domestic yields and looking at what's going on in South Africa. In South Africa, what I thought we'd do is ask our portfolio manager on the Anchor BCI Core Income Fund, Leletu Poswa, to join us and just to give us his perspectives. Hi, Leletu.
Afternoon, Nolan. Afternoon, everyone.
Thank you very much for joining us, Leletu. So, as I look at what I've just said, I think there are really 3 factors that we need to be cognizant of when we look at the outlook for the markets, certainly for the income markets, and that is economic growth, inflation, and sentiment. So, starting with economic growth, what is your outlook for South Africa and our economic growth in 2025 and beyond?
So we're quite positive on the local economic growth outlook. We expect the local economy to grow just under 2% in 2025, largely driven by household consumption. We're constructive on consumer spending as consumers continue to benefit from low inflation, lower interest rates, and additional cash injections coming from the two-pot system, which we believe will sustain growth throughout 2025.
Thank you, Leletu. So that's maybe good news for South Africa. We are talking about economic growth that's significantly higher than we've seen for a while, maybe outside of the COVID era. But along with growth often comes inflation. So what's your outlook for inflation in South Africa?
When it comes to inflation, we view the inflation environment to remain subdued in 2025. We expect headline inflation to gradually increase from current levels, largely due to the normalizing of food and fuel prices. We expect headline to reach the preferred midpoint of the inflation band of 4.5% by the second half of 2025. and thereafter stabilizing as inflation expectations are well anchored. Given that inflation is expected to remain well below the preferred 4.5% midpoint, we see that this is an opportunity for central bank to cut interest rates by at least 25 basis points in 2025, or a further 25 basis points in 2025.
Thank you very much, Leletu. So maybe some good news for consumers if we're talking about stronger economic growth and inflation and coming down, interest rate cuts as a consequence. Finally, what's your take on sentiment in South Africa, particularly focusing on the government of national unity? I think we saw a big boon of positive sentiment when the government was formed. Where do we stand on that and the outlook for the sort of government holding together?
Political stability is very important for South Africa's growth trajectory. The establishment of the GNU last year played a critical role in restoring confidence domestically and internationally. Our base case is that the GNU will remain intact, with the 2026 local government elections likely to be a potential stress point for the GNU.
Thank you. So from that perspective, I'm hearing that it actually is looking like a continuation of the positivity that we saw last year. So that is great for South Africa, and very much an expectation that as the GNU holds, yes, it's going to have bumps. Yes, there's going to be a bit of politicking into the local elections, but we're kind of seeing the long-term outlook of pulling it all together, holding together, having more benefit for the parties involved than sort of being the ones to break all of this apart. So overall, it continues to be a pretty positive discussion around South Africa, whether you talk economic growth, whether you talk interest rate cuts, whether you talk sentiment. And from that perspective, we think that there are 2 interest rate cuts in South Africa. We had one last week, and that means we think that there will be one further interest rate cut in the first half of this year in South Africa. There is certainly, if we're wrong, a potential for a second interest rate cut of 0.25%, but it's kind of touch and go from that perspective. The fundamentals in South Africa continue to improve. At this stage, I think it is plausible that we will start to see rating agencies talk about moving us to positive outlooks towards the end of the year. So that in itself is also very supportive of South Africa. We like the core income portfolio. I think it continues to give you low risk, particularly because we are aware that Donald Trump is going to bring surprises. He is going to bring volatility to the markets. And that sort of stable foundation upon which one can build your portfolio is the core income fund. And then, if you're looking for a little bit more upside, you want to benefit from interest rate cuts, we like the flexible income fund. Finally, turning our attention to the South African rand. As Peter said earlier, in a world where potentially the election had gone the other way, we'd have been sitting in a situation where the rand would have quite realistically been trading with a 16 handle on it. Alas, it wasn't to be, and you can actually see that, I mentioned earlier that the currency is meaningfully weakened once it became apparent that President Donald Trump was going to win the election. Looking at the model, Anchor continues to hold with our purchasing power parity model, which says that the long-term sort of performance of the rand versus the dollar will sort of match the inflation differential between the two currencies. If you look at this, what you've got is the sort of thick band in the middle, and that's actually where the modeled fair value of the rand is. And you've got the squiggly line, which goes all over the place, which firstly says that the rand doesn't listen to our spreadsheet. But secondly, if I look at it, what it is signaling is that the rand is oversold at the moment. If I look at the potential impact of policies at this stage, I'm not seeing anything that will meaningfully depreciate the rand. Yes, we're going to go through shocks, but one would expect that the rand will recover some of the losses from where it's at right now. And from that perspective, we see a greater propensity for a little bit of rand strength rather than rand weakness. We've modeled on 1825 for the end of the year. We model on over a 12-year period. So we're not saying massive runaway strength, but more we're saying that, yeah, we think the rand can regain some, a few of its losses. So from that perspective, I'm going to end it there. And thank you very much for your time. I'm now going to hand over to Liam to take us through domestic equities.
Thanks, Nolan. Yeah, and it really, that economic overview of South Africa really does sort of set the pace for where we currently find ourselves for South African equities as an asset class, and certainly helps shape our views from the top down when we create expectations for the bottom up, which is obviously what we place the bulk of our emphasis on when we create a total return outlook for the JSE. So just as a reminder, firstly, I'm Liam Hector. I run some of the local equity funds for Anchor. And when we create these total return expectations, we model roughly about 85% of the local equity market. It's possible to do in South Africa because the market's quite narrow. A lot harder to do that offshore. And with our modeling, we've got the capacity to go bottom up on the bulk of our local market. And I would say that the overriding message here is, and certainly ties into what Nolan's saying, is that fundamentals have continued to improve for South African equities probably over the last 9, possibly 12 months now. So we have the message is that we staying the course. We've been overweight on this asset class for about a year now. Certainly helped along by the formation of the Government of National Unity last year. But what's been nice to see is that there's been a few other catalysts that have come through that have created some earnings momentum for the first time in South Africa, particularly on the domestic side. So things like the banks and the retailers. It was a long winter for them over many years. And as uncomfortable as it is sometimes to go overweight or become bullish on this, considering what a lot of people's lived experiences are in South Africa, the way that and the shape of the market now is that a mid-teen total return from something like the banks index can have quite a profound impact on the overall total return of the JSE. So when we break it down, we're getting quite a lot of upside and dependable upside in sectors like the banks in South Africa. And with the recent pullback that you saw from the likes of Naspers to levels that we find attractive, which we'll touch on in later slides, between the banks and Naspers, you can already get a fair chunk of the total return for the market over the course of 2025. And it's quite interesting. We've already had some quite healthy contributions from the likes of BTI or British American Tobacco and CFR, where our models didn't actually have the amount of upside that we've seen from them. And then also quite healthy contributions from the gold sector, which has now become quite a material contributor to the JSE from an index perspective, and still with what seems to be improving fundamentals there. So from a bottom-up perspective, you're still seeing quite a lot of earnings upgrades and healthier earnings upgrades come through with cash conversion levels for the first time in many years, very healthy in the gold sector. The views on South African equities, we haven't changed them all that much over the course of the last 3 months. We certainly find ourselves in a position now where we created a set of expectations, and the market certainly has. And we're currently in the process of evaluating whether or not those expectations were too high. So we're starting to see earnings and results coming through from the companies. There's certainly evidence to suggest in the current results that there's been a small resurgence in the South African consumer. All the factors that we've been speaking about for the last sort of 6 to 8 months now with interest rates gradually coming off, the CPI number being quite favorable to further encourage that, which we'll touch on in the next few slides. But then also pension fund regulation changes in rules changes in South Africa has also added a little cash injection, albeit possibly short-lived, into the consumption in South Africa. I would say what's been very difficult in creating this set of expectations, more so than the last, has certainly been the level of uncertainty that's been created by having the Donald Trump president in the US. As I think it's already been spoken about by previous speakers, but it just adds a level of uncertainty for us from a forecast perspective, in terms of what multiples to pay, if it's going to impact risk-free rates and the like. But for us as a process to just try and use experience and lessons learned from the past to just head down and focus on the fundamentals and the bottom up and the things that we can clearly observe in the market when creating those expectations. So I think just making the point that for us, we do concede that there's going to be a lot more, almost headline roulette that's going to be played over the course of the next year, and certainly, you started seeing that over the weekend with the headlines that were coming through. A quick one just to contextualize, the overweight call, or certainly the bullish call on the banks. You've seen over the last quarter quite a material pullback across the local banking sector. So, at the time of creating the slide, it was about 15%, which we consider straight derating or have the banks becoming cheaper. There's been very little in the form of earnings volatility from the analyst side. So earnings expectations have not come down for the banks, and the share prices have. At the same time, the bonds in South Africa have been fairly stable. Certainly nothing to suggest a 15% pullback was on the cards. So from these levels, I think that it's fair to create a mid-teen total return expectation, with the pullback currently offering a good entry point over the course of the next 12 months. So you're getting, double digits earnings growth across the sector with very sort of stable to high single-digit dividend yields as well. So sort of mid-teen earnings or total return expectations across the banking index, which is close to a quarter of our local market now. Another a chart we like to use, which I get from the economics team at Anchor, is just to show how much wiggle room there would be for the SAR, but we do understand that there's a different set of priorities that they've got there, that possibly it's not purely just CPI linked. And even though they're talking about a lowering of the band, it still suggests that there's been quite a big decoupling from where interest rates currently sit in South Africa and where inflation is. So we think that there's a lot of room, and this is unduly penalizing investors on the JSE. And if you could get some kind of compression between where CPI sits and where the reserve rate sits in South Africa, you could get quite considerable upside as well on our local market. And then just a few comments on Tencent. There was obviously a lot of news flow around. This was almost the first shot across the bow that we had to deal with this year. We've been bullish Tencent for quite some time. And earlier this year, there was an announcement that Tencent had been placed on a list of companies with close military ties to the Chinese military by the US and the Pentagon. Our initial response to that was that it was going to have very little impact on Tencent's operations. And once again, having seen been whipsawed by headlines on particularly this sector in Chinese internet in the past, the team's initial reaction is to place a huge amount of emphasis on the fundamentals and the bottom up of the company. And going back in time, we've often used these big headlines and knee-jerk reactions in the market to accumulate. So that we've held our sort of 12-month view on Tencent. It hasn't changed materially. And coming into the year, we had north of 20% upside. So when it got hit 10%, it became a sort of quite high conviction call for us to come in and suggest that, well, conclude that there wasn't going to be a material change to the operations of the business as a result of the headline, and that you're probably going to find over time that Tencent is going to exonerate itself through the courts. This is a big business, very diversified, with very little operations that would be impacted by the decision out of the States. But just to once again contextualize what we're expecting from this company, pretty robust operating earnings growth over the next 2 to 3 years. Very little contribution coming from the investment portfolio at the center, which is close to 20%. Which makes up close to 20% of the market cap. So there's potential for optionality here if assets are disposed and realized. But you're entering into a period now with Tencent returning to what we would consider quite healthy growth levels. And as the previous slides showed, it got down to about a 14 times earnings, which in the past has been a pretty attractive entry point for those sort of patient or longer term focused investors. Another bit of fuel to the investment case here is something that people don't often place a lot of emphasis on, but Tencent is probably in the middle of its biggest buyback that they've embarked on since incorporating the company. At the lighter blue bar chart at the top is the dividend yield. So it's on about a 1% dividend yield, but at the same time last year gave back about 2.5% to shareholders in the form of buybacks as well. So if you annualize that, and assume that it's going to continue again this year, you're looking at close to 4% of capital being returned to shareholders as well. So that creates a nice underpin to the investment case, and also certainly highlights why we consider this one of the better management teams, certainly across emerging markets, and why we think in most emerging market portfolios it's offering one of the most compelling investment cases, and we are lucky to have exposure to that on the JSE. Just to once again reiterate, we've got a basket of mid caps that we've continued to hold. Certainly over the last 9 months, as the GNU happened, we took a basket to some of the companies we had held before, but companies that we believe are in the middle of a material change in circumstance. We think that the conditions in South Africa have gotten better for these businesses, certainly over the course of the last 12 months, and that they provide portfolios in South Africa for the first time in many years, real added optionality in terms of earnings coming through. So we believe that there's going to be some robust and dependable earnings growth that is going to come through from the likes of Southern Sun and Lewis, both highly geared to the changing circumstances over the last 8 to 12 months in South Africa. In terms of tying it all back, once again, just to say, we're expecting about 15% out of JSE equities this year. There's been some quite big dispersion across the local market, particularly in January, and there's been some uncomfortable moments. But in terms of focusing purely on the fundamentals, we believe that there's still some good fundamental value on offer in the JSE. But once again, concede that this year is going to be a lot more headline driven, and we're going to have to stay very focused on the bottom up, just to eye on the horizon and not get too whipsawed by what's going on globally. And with that, I think I'm over to Peter to wrap it up.
Hi, Liam. Thanks, guys. We've got kind of 80% through the conversation. Please, if you want to ask some questions, put them in the Q&A. I'm going to talk for about 10 minutes now, and then we're going to have a Q&A session where we can post the various questions. So I'm going to talk you through global equities. Right, so moving on to global equities. I think where we're coming out with from an expectation point of view is that things look pretty good. If you were to base it on the earnings outlook for US companies, they're talking 14% this year, 12% next year. Those are pretty big numbers. But when things look good, prices are seldom cheap, and that's kind of where we find ourselves. I think at the same time, the economic environment from a geopolitical perspective, from what Trump's doing, from the huge change in the global outlook from a day-to-day perspective with artificial intelligence. A lot of these things can fundamentally be good for equities, but they can also create surprises. If you look last Monday, we woke up to Nvidia being down 18%. After DeepSeek got revealed, and that's what's happening in the AI world. Every now and then we get a little bit of a window into what's happening around the world. For those of you who are not familiar with what DeepSeek is, everybody thought that AI and these large language models and AI modeling companies would be dominated by the American companies. Suddenly, a Chinese company revealed itself. Well, it's been around for the last few months, but got real attention on the weekend. And they claimed or indicated that the product they had created, and the product reviewers reckon it's just as good as OpenAI, ChatGPT, but they produced it for a fraction of the price. So this, of course, brought into question, the huge amounts of money, the tens of billions of dollars that all of the big tech companies are spending. So with valuations at close to all-time highs, or certainly 20-year highs, people are saying, if any of the assumptions that we're making are over-optimistic, the market can come off quite quickly. So trying to put it in kind of two different camps. From a bull case perspective, we are in a bull market. One of the things I've learned a few times in my career is don't call the end of it too early. So we're not necessarily calling the end of it, but you can certainly see some consolidation start to set in. And the economy is good. Trump is pro-growth. Everything that he's doing is trying to loosen regulation, and there's a lot of good stuff happening from an economic perspective. But he's also taking actions, as Nolan indicated, on things like tariffs, which can have impacts which might be unintended. So a stronger dollar means weaker earnings for US companies that earn money from outside of America, and interest rates being higher mean that the interest rate cut expectations and interest lines in company forecasts for 2025 might not be as positive as otherwise imagined. So the attractive outlook doesn't come cheap, but the bulls are saying there's limited multiple compression. It's always very interesting at the beginning of the year to have a look at the forecasts of all the big investment banks, and most of them have the S&P at kind of 6,300 to 6,600 at the end of the year. So nobody's being too bold either way, and it's it is very difficult. It's for the market to put another 15%. It then would become incredibly expensive. And while we are growth investors, we'd rather pay up for a company that's growing. We certainly are valuation sensitive and cognizant of valuations. So the bulls are also saying that all the big price rises have come from the Magnificent Seven, but their earnings have also risen very, very strongly. Outside of the US, you almost have the opposite. The Europe and Japan look very cheap. So there you've got much lower economic growth. A lot of the growth in America might well come at the expense of Europe and Japan. China, certainly in our day-to-day lives, on the motor vehicle front, you're seeing a lot more acceptance of their motor vehicles in terms of quality and brand and relative to price. I certainly in my own life, I'm seeing people prepared to go down that road. So that's the bull case. But it's hard to picture another 20% year like we had in 2024. The bear case is if things don't turn out as expected, it's very easy to have a 15 to 20% correction in markets. And it's that kind of fear that's making us a little bit cautious. That is what you get in equity markets. For those who've got the ability to stomach, those kind of drops. Something like Amazon on the way to going up 1,000% went down more than 50% 3 or 4 times. So if you are looking for the kind of returns that come out of equities, and we are long-term equity bulls, we think that that's where real money is made over the long term. We'd sit through this, but there are some reasons to be cautious. I'm going to talk you through the equity risk premium. Bull markets don't last forever. The forward 22p multiple is at a 25% premium to the 15-year mean. And the market is clearly priced for perfection. So as we were saying, last Monday it was DeepSeek. This Monday, markets are coming off by a few percent because of tariffs being announced. So, you can see the market sensitivity to things that are denting that kind of perfection outlook. And then the as we indicated, the strong earnings forecast. So it's a little bit of risk because a 10% stronger dollar means if you're earning euros and money around the world, when you bring that back into America, you're going to earn less dollars. So that's kind of the picture that we show, the words that I'm using. The 6% return that we're looking for. We think if US economic growth is stronger than anticipated, that could be a 10% to a 12%. But we've got an unusually high downside. If US economic growth falters, something happens that's unexpected, the market can go down 20%. Normally, our range of outcomes would be in a 10 to 15% band. But I think this illustrates, kind of how we're feeling about things. And then the global bonds in the middle, where the range, and bonds are a lot safer because the range of outcomes is a lot lower and bond yields are pretty high. Looking back quickly over 2024, and you guys are welcome to have copies of this presentation. Just contact your wealth manager or financial advisor. So developed market equities, about 19% in 2024, so a very strong year. You got almost all of that, well, a lot of that out of America. So very few fund managers got anywhere near that number because you needed to be invested materially in America and in a few specific shares. So you can see other developed markets kind of in the 0 to 10% range. The UK only up 7.5%. And then in that equity return in America, the 25% return that came out of the American market, 5% came out of NVIDIA. So if you simply excluded NVIDIA from your portfolio, that was 20%. And the Magnificent Seven, the big tech companies, their contribution as a whole was more than half of the return. So you needed to have big weightings across the board to achieve anywhere near the kind of market return. You must remember, of course, that can reverse quite quickly. If they level off, these companies, they now contribute about 30% to the S&P. The top 10 companies are 40% of the S&P. So there's massive concentration in the big companies. Tech has made it possible for companies to become virtual monopolies in many ways, or certainly very dominant players, because without adding too much fixed costs, that can bring on more and more customers. A great example for me is something like Netflix. Every movie that they make costs the same amount of money, but they've got more and more subscribers. So the profitability and the margin just keeps on kicking upwards. In 24 was not a great year for yielding assets. So this is a graph showing the US 10-year government bond yield. And you can see right through the course of 2024, the bond yield had started to come down. Inflation expectations are coming down. And people are making very nice money out of bonds. As it became evident that Trump was coming into power, 10-year government bond yields kicked up very quickly by about 80 basis points. And that was basically reflecting a change in interest rate expectations in America, because inflation was seen to be kicking up. So global bonds, in fact, gave a minus 1.7% return last year. And you really wanted to be primarily in equities. Commodities struggled for a second consecutive year. They're very much driven by China. So you can see lots of negatives. Iron ore is the major one. Iron ore was down 27%. That's the key earnings driver of all of the big mining companies in the South African market. But the one commodity that really did nicely was gold, up 27%. And that's obviously on the back of increasing inflation expectations. And then, as Nolan alluded to, the dollar effect. The dollar strengthened against the average currency by 7% last year. So the rand weakening by only 2.6% meant that the rand actually strengthened against most other currencies, and very negative experiences for most of other emerging markets. So, the South African factors countered somewhat what happened with the dollar. And then I think Nolan's been through a lot of these numbers. I think let's move across to the S&P multiple, which you can see here has averaged about 16 over the course of the last 20 years. It kicked up to similar levels to today, back in 2020, but that was more to do with a sharp decrease in earnings and a re-rating of the market. So a very healthy multiple and not much room for things to come down. So I'm now going to quickly talk about the equity risk premium. We don't normally get this technical in our presentations, but I think it's reached a level that it's worthwhile pointing out. So the equity risk premium is effectively the yield that equity investors require to compensate for the risk in equities versus bonds. So to put that very simply, if a company earns $5 and it's trading at $100, it's a 5% yield on the market price. If you turn that around, it's a 20 PE multiple. Now, the bond yield is much simpler to understand. It's simply the yield that you're getting on your bonds. And usually the equity yield is about 2 to 3% higher than the bond yield. Because if you know that there's a no risk 4% that can get returned or 3% that you can get out of bonds, you'd be looking to earn 6 or 7% out of equities to compensate for that risk. And this green chart over here indicates, right going back to 1998, most of the time you sit kind of between the 2 and 4% level. And that's the way most people view risk and take a view on how to price bonds versus pricing equities. So why we're highlighting this and creating and putting this in our presentation is for the first time in over 20 years, it's now gone negative. So what that's telling you, you've got an earnings yield of about 4.6%, which is a forward 22 P multiple, and a bond yield of 4.6%. So if you own the S&P ETF and own the bond yield, your yield on what you've invested in is roughly the same. So it's an indication of either bonds are very cheap or equities are very expensive, or the reality is, kind of a combination of the two. So in our asset allocation, we're coming out to the view which is overweight bonds, and we've now gone neutral to equities. So just to show you how that's made up, this is the US government 10-year bond yield, and you can see that that's 5%, which is where it's heading. There's a very high level. It's sitting at about 4.6. The last time it got to 5% was in 2006, but it's been in the kind of 2 to 4% range for quite some time. Got very low in 2020 as they dramatically cut interest rates down to 0. So that's the bond, that's the 4.6. We then look at the earnings yield, which is earnings over market capitalizations. As I said, 5 Rand of earnings and 100 Rand value is a 5% earnings yield or a 20 PE multiple. And that's now sitting at 4.7%. So the 4.6% minus the 4.65, you're landing up with an equity risk premium of virtually naught, which, in economic theory is indicating that, we're at a point where they're at extremes in terms of the one versus the other. This doesn't always work as a predictor of markets. I think Morgan Stanley famously about 2 years ago, when the ERP got down to 1%, they said that wasn't enough, and they forecast the S&P going down to 3,500. 2 years later, you're sitting at 6,000. So part of the reality as well is it's very difficult for us to forecast exactly where markets are going. We do tend to focus bottom up on high quality businesses, and that's where we invest, but we have to be cognizant of these macro numbers. The high valuations are very much the domain of America. This is the European market, where the forward P multiple is sitting closer to 14, with an average of around kind of the 13.5% level. So, the prospects for European businesses certainly don't look anywhere as good as American companies. All of the tech and the AI growth and the like is focused on America, and Europe and the UK are lagging. This is US earnings growth. You've heard us talk about it quite a lot. So very strong earnings growth forecast for the next 2 years, and that's kind of what's being priced into markets. So the last thing to talk about is alternative assets. So outside of the vanilla markets, where prices can move quite sharply, we've put quite a big focus on giving investors access to alternative assets over the course of the last few years. And what does that mean? It's private equity, it's private debt, real estate, hedge funds, infrastructure, structured products. So companies which have an underlying yield or assets that we think can grow quite nicely, that don't have the same kind of volatility as markets. In Anchor, we put together 3 alternative funds, one locally, where the target is 10 to 15% with low volatility in rands, And that's really what we find most of our investors are looking for. You know, we've got about 6 billion rand sitting in our core income fund, earning about 9%. And a lot of that is because people, people are looking for a place of safety. And if you can earn real inflation beating returns without taking the risk, that's a very attractive asset pool. So, we think within that kind of lower risk type space and mindset, an alternative fund makes a lot of sense. So we have one in rands, and offshore, we've got 2 different alternative funds aiming at between 8 and 12% in US dollars. I think, what's quite exciting is it gives people the ability to invest in assets that they otherwise wouldn't be able to invest in. And this is our local alternative funds. It's called the Prime Alternatives Flexible QIF. And you can see the return profile is certainly a level above the income type funds. But because it's not reacting every time equity markets go down and value is accreting steadily over time, I think the return last year was just under 12%. But it's a nice kind of steady return that kicks through without waking up in the morning with a shock. So it also gives you the opportunity to invest in things that you wouldn't otherwise be able to, or that, tying your money in for 5 to 7 years. So within this fund, there's some European data centers, a very exciting US fiber business. The best performing asset has been a Maltese debt collection business, some UK logistics properties, and imminently we're busy negotiating some US pre-IPO tech businesses. So you can see on the right-hand side, no one asset class has got massive exposure. The hedge funds is the highest at 22%, but that's across 3 or 4 different hedge funds. And it's just a very nice asset mix run by a very high quality group of people that we hope, will continue to deliver the returns. So, that's a very nice building block in building a portfolio. But to go back to where we started, domestic equities, we're looking at 15% rough returns. We think the SA economy, interest rates coming down, the two-pot system, government of national unity continuing to kick through. The prospects for South Africa look a lot more promising than they did 18 months ago. So we continue to back that story. From a global equity perspective, we've moved to neutral. The bull markets might well continue. The AI and what can be achieved in the AI world is simply mind-boggling. But that doesn't mean that all the companies that are invested in AI are going to be great investments. And Seleho identified that right up at the beginning in our first presentation. So share selection becomes critical. And from a fixed income perspective, the world has changed a little over the course of the last few months as it became clear that interest rates would level off at a higher level than what we expected 6 months ago, largely driven by the actions of Trump. So if you're a conservative investor and you have capital, you can earn very decent inflation-beating returns in South Africa, and still some very nice yields available in global. And that is the bulk of our story. So I'd ask our guys just to put their cameras back on. We've got some questions in the Q&A, and we'll run through anything that people want to talk about. These days, it's normally about Trump, Bitcoin, or DeepSeek over the course of the last few weeks whenever we chat to clients. So we can answer any of those questions. But I think something that is quite pertinent, and there's a question on the forum, Nolan, is higher bond yields in America. So it costs the government, the US government, more to borrow money. US government's debt levels are numbers that people can't even kind of conceptualize. What does it all mean for the US balance sheet, the ability to service their interest, and the future for ourselves and our children?
Pete, yeah, thank you. That's a thorny question that I think multiple economists are wrestling with. But, if you look at it, the US debt levels have been increasing quite consistently. It's about 125% of GDP at the moment. Put in context, that's actually significantly higher than South Africa's 75%. Put in context, though, it's also about half of the debt levels that you see in Japan. So it's not by any means a particularly extreme scenario. The point is, as long as your debt costs you very little, it's actually very sustainable. And you see that in Japan, interest rates are about zero and the debt levels are not a problem. The thing is, in the US, interest rates aren't zero, and the composition of or the sort of interest costs, servicing costs of debt have been growing. You're starting to see it, like in South Africa, where people talk about, it being one of the bigger factors within the national budget, creating, spending pressures. That becomes a self-fulfilling prophecy, because in order to service the debt, the US needs to borrow more, and it becomes tricky to manage your way out of that. At this stage, it looks like it's sort of finally in balance, if I can put it that way. So, at about a 5% debt interest rate, the US is able to, service its debt. The deficits are not expected to get out of control. They're expected to probably continue around current levels. And don't forget that, up to just under a third of the US debt actually is held by the Federal Reserve at the moment. So it is the US paying interest from, one pocket to another pocket of the US government. So it's a little bit more tricky to unpack all of that. The key concern is that, I keep getting asked the question, as these debt levels rise, do we think that's going to put pressure on US bonds? Do we expect the yields to keep going up? And definitely we are seeing elements of that in the market. But at this stage, I think there are other factors which we've mentioned already, which are more important to the outlook for the markets. So, it's something to keep an eye on, but it's certainly quite far from being the primary driver of the markets.
Liam and Saleo, maybe to ask your views on two things out there. Quite a few questions on the Q&A on China. I think China has been a terrible investment for many, many years for lots of different reasons, but is now the time to be looking at it. Towards the end of last year, we had some stimulus, a kick in the market. South Africa is obviously quite impacted by it. So that's the first one. And then secondly, inevitably, what happens for crypto now? Trump has become a lot more positive crypto. It's not an asset class that we invest clients' money in. But maybe to have a go at those two. Do you want to start, Liam?
Yeah, I'll deal with China. I'll leave crypto to so Pete, I think the Chinese deliberately they have been deliberately trying to reshape their own internal economy. There's no doubt about that. That's been going on for a good few years now. Not all of their decisions have been market friendly. I don't think there's any question about that. But where we found ourselves, certainly towards about September last year, was that sentiment was incredibly low. It still remains fairly low, but policymakers have made a concerted effort to change their tone. So at a policy level, the backdrop for China, certainly financial assets in China it seems to have become a lot more supportive. And it appears as though that they are going to make a concerted effort to arrest deflation there, which is for financial markets one of the worst and most toxic cocktails you can deal with. Demographic headwinds plus deflation, and it looks as if China, from a policy perspective, has certainly turned a corner, and there's a concerted effort from them to pull out all the stops to try and reflate the Chinese economy, and we've typically found that is well received by financial assets. So you've already seen a reaction in the Chinese stock market has been fairly positive over the last quarter, and continued into this year. It doesn't always feel that way, especially if the only thing you focus on is China tech. But if you look at broader Chinese indices, they've actually been performing okay over the course of the last 3-4 months. And it all remains to be seen whether or not the policy support that's being injected into the economy is going to completely solve their issues. But certainly it appears as though over the short to medium term, they're going to be quite supportive for financial assets in China.
Yeah, just on crypto, I guess what we can say is that the regulatory environment is a lot more supportive today than it was a year ago. So under the Biden administration, the SEC chairman, Gary Gensler, was quite adversarial towards crypto, whereas Trump himself and his administration is a lot more pro-crypto. I mean, President Trump and the First Lady, it feels weird to say, but they launched meme coins themselves. So I think the first thing to say is that the regulatory environment is a lot more supportive. With that said, I mean, I'm no crypto expert, but it does feel like there's a lot of froth out there. So I don't know if I can even say the name, but Fartcoin is worth, last I saw, $2 billion. And it might seem like an anecdotal story, but I think just the fact that something that explicitly was created to have no value and almost as a bit of a meme and a joke can perform as well as it has done suggests that there is a lot of, the market has run very, very strongly. I think since Trump was elected or re-elected, Bitcoin's up about 70% or so, or 60%. So yeah, we've had a lot of performance in the last, 2 to 3 months. But longer term, you could say the US is now talking about a strategic reserve for Bitcoin. So the regulatory environment's a lot stronger, but it does feel like it's frothy at the moment.
Yeah, I mean, I think maybe to add to that from a company kind of investment perspective, we obviously in many instances taking people's lifetime savings, people that they've spent a lifetime creating piles or sold an asset, and we just feel it would be irresponsible to fundamentally put money into another asset which has no underlying value. I don't think anybody argues over the fact that there is no underlying value. There's no company, there's no earnings, there's no dividend yield. And Bitcoin and the like is literally a supply-demand equation over an instrument that has no value. Now, a lot of the arguments, and when people are bullish about it, and what Celio is referring to, is that the supply-demand equation for Bitcoin has been very positive over the last 4 months. I think there's clearly some agendas to get the price up from a Trump perspective. It was quite telling when he launched his own coin. When Elon Musk started backing Dogecoin last year, it was literally a joke to start with. But supply, people's human behavior, herd behavior, the creation of all the bubbles in history, they can last a long, long time. So I can certainly sit here and give you a very positive view on the supply-demand equation for Bitcoin and some of these coins. And I think there probably will be some quite positive kind of supply-demand dynamics for them. It doesn't change what the underlying is. And I think the answer that we give to a lot of clients who've got an appetite for it, because these things really do fascinate people, is, outside of a portfolio that we manage for you, we're probably not going to include that in portfolios unless something fundamentally changes. Take 1, 2, 3, 4, 5% of your investable money. If you're the kind of individual that wants to take a bet, do so. It's we think that it might still well go up. There's lots of people saying that Bitcoin goes to $1 million. I've got no idea. If Bitcoin went up or down 50% in the next 4 months, I probably wouldn't be able to tell you why either of those happened. So we're not dismissing it as an asset class. I think it's got a lot more credibility over the course of the last year, but understand fundamentally what it is. And I don't think there's anybody in the world who can tell you with a massive amount of confidence where it's going over the course of the next few months. So compared to the kind of things that we're going to put your money into, it's a bet, it's a gamble. It can move, you shouldn't be surprised. Most of the assets we invest in would be massively surprised if they went down 20% over a 2 or 3 month period. This is an asset where you shouldn't be surprised if that happened. So, a lot of us back at the office who play with it, but we do so with our own money in the full knowledge of exactly what we're buying, or let me put it differently, exactly what we're not buying. I think, Celio, going back to you, there's a question on PGMs. Celio helps us look at mining companies, the likely effect in PGM prices in 2025 as a result of Trump's protectionist policies. Just a quick view on that. I think we haven't got too long left, so we'll have 1 or 2 questions after that, but just a bullet point answer.
Yeah, the US has, or there have been reports about the US potentially sanctioning Russian palladium in particular, because Russia's palladium, a lot of palladium comes out of Russia, but we haven't actually seen anything material happen yet. And I think what we've seen from sanctions on Russian energy is that it's quite hard to put into place in practice. So the metal ends up finding its way into the market through alternative means. Maybe what we can say about PGMs at the moment is they're going to start reporting. So the PGM mining companies are going to start reporting this month. It's likely that it's going to be a difficult earnings season for the companies. But it looks like potentially maybe the basket price has troughed. So palladium and platinum are both over $1,000 per ounce. I think both got to around $900 or so. So it looks like perhaps the basket price has troughed. It's up a little bit year to date. It's still at this basket price. Things are still challenging, but it looks like maybe we've seen the worst of this downturn. But it'll be a tough reporting season for them.
Okay, guys, we reached the end of the time that we had allocated. For over 1,000 people listening and watching, thank you very much. It's an honor that you're giving us of your time. I hope you valued the views. It's a very exciting, if nothing else, investment world out there. We certainly can't take a day or two off without something happening on markets that we have to kind of assess the impact and look at the opportunity. But from everybody at Anchor, thank you very much and have a great investment year.